You know, the uranium market is presenting a puzzle that we just don't see very often in commodities. On one hand, you've got prices climbing and fundamentals that are frankly screaming bullish. But on the other, the companies that actually need to find new supply, well, they're being starved of capital. It's a real paradox, and in this explainer, we're going to break it all down.
All right, first things first, let's talk about the bull market side of this equation. The uranium spot price just hit $99 a pound. That's a 17-month high. I mean, by any measure, the price action is strong. It's signaling a market that is getting tighter and tighter, literally by the day.
And this, right here, is the key idea for this entire breakdown. The supply crunch that's coming, it's not some wild guess or some analyst's hot take. It is a mathematical certainty. It's based on known reactor demand versus known production capacity. So if the deficit is just simple arithmetic, why isn't the market acting like it?
Well, that brings us to the central question, doesn't it? If the fundamentals are this solid, where is all the investment capital? As it turns out, it's being completely mesmerized by the siren song of precious metals. I mean, just look at this. The sheer scale of the difference here it's staggering. Last year, Sprott's physical gold and silver trusts pulled in a combined $2.5 billion. Uranium exploration? Practically nothing in comparison. Precious metals are just sucking all the oxygen out of the room. And here's why. Look, a 30% return for uranium is solid. It's respectable. But it's just dwarfed by what's been an absolute banner year for gold and silver. When you're seeing returns of 50, even 120%, well, that's what grabs the headlines. That's what captures investor attention and momentum, and it leaves uranium in the dust.
But this is more than just a distraction. It's a deep, structural problem. There are some very fundamental reasons why money isn't flowing into uranium exploration, even if investors wanted it to.
First off, the supply side is incredibly concentrated. Just 10 companies, that's it, 10, control over 90% of all global uranium production. Now this creates a huge barrier to entry, a super narrow field for any large-scale investment, and maybe most importantly, it injects significant geopolitical risk into the supply chain, right? When so few control so much, any little disruption has massive consequences.
Now, on the other end of the spectrum, you've got the junior explorers, the little guys tasked with finding tomorrow's supply. But here's the catch. About 90% of them are just too small. They don't meet the minimum investment thresholds for the big money players, you know, the pension funds, the university endowments. This creates a huge structural roadblock. An entire chunk of the market is effectively uninvestable for the largest pools of capital out there.
And get this, sovereign wealth funds manage nearly $12 trillion in assets. Yet their allocation to finding new uranium supply is, for all practical purposes, zero. Why? Well, it's often due to political mandates, public perception, or ESG policies that just haven't caught up with nuclear's modern role in decarbonization. So all that capital is just sitting on the sidelines, unable to fuel this nuclear renaissance we keep hearing about.
This funding gap creates a really critical split in the market. To really get what's going on, you have to understand the difference between the big producers and the small explorers. They are two completely different worlds. You know, in this kind of capital-starved environment, a strange thing happens. The marketing machines, the companies that are fantastic at telling stories and building hype on social media, they often get the funding over the real players, the ones who are quietly doing the hard, tedious geological work. This creates a really serious market inefficiency for anyone who knows what they're looking for. So here's the bottom line. While the big producers like Cameco and Kazatomprom are doing well, their upside is pretty much understood. It's already priced in by the analysts. Their value is calculated. But the real, explosive, life-changing returns in a commodity bull market, historically, they come from exploration success, that surprise discovery that completely rewrites a company's future. And right now, that's the very part of the market that's being completely ignored and underfunded.
But this kind of dislocation, it can't last forever. The professional market, I'm talking about the utilities and traders who actually buy and sell physical pounds of uranium, they're seeing something that the equity market is missing, and it signals that this window of opportunity is starting to close.
This chart, this is what the real players are looking at. It's the uranium forward curve. It shows the market is in what's called contango, which is just a fancy way of saying the pros are betting that the price of uranium will be higher in the future than it is today. You can see it right there. They are pricing in a rise to over $103 per pound. This isn't just speculation. This is the utilities themselves locking in future supply at higher prices because they know the market is getting tight.
And this is where it all comes together. That forward curve, which is predicting higher prices because of a supply crunch, is directly linked to that capital desert we just talked about. If you don't fund exploration today, you simply cannot develop the mines needed to meet demand tomorrow. It's really that simple.
So, as we start to bring this all together, the entire situation really boils down to a conflict between two powerful forces. You have the hard, cold math of a supply deficit on one side versus the fickle, momentum-driven nature of market sentiment on the other.
Okay, so what does the math actually say? Well, based on the known demand from existing and planned nuclear plants, minus the known production from all current mines, the world is facing a cumulative supply deficit of 197 million pounds of uranium by 2040. That's not a guess. That's just the result of adding up demand and subtracting supply.
And to make matters worse, this problem isn't getting better, it's getting more acute. This chart is from Kazatomprom, the world's single largest producer, and it forecasts their production is actually going to decline in the coming years because of their own challenges. This takes that deficit arithmetic we just saw and makes it even more severe.
And here is the core insight of this whole explainer. For anyone looking at this space, the real danger isn't necessarily being wrong on the fundamentals and watching prices fall. The real risk is being too late. It's missing the massive re-rating that's going to happen when the capital that's currently chasing gold and silver finally rotates back to the undeniable arithmetic of the uranium market.
Because when that capital does rotate, this inefficiency we've been talking about is going to correct itself, and it's probably going to happen fast. The smart money, the industry insiders, the utilities securing their future supply, they're already getting positioned. The window to buy quality exploration assets at these kinds of distressed valuations, it's closing.
Which really just leaves us with one final thought. The market will eventually wake up to the arithmetic of the supply deficit. It always does. The only real question is when. And when that day comes, will you be early or will you be late?